What is interest rate risk? Interest rate risk is the chance that an unexpected change in interest rates will negatively affect the value of an investment. Interest rate risk exists in an interest-bearing asset, such as a loan or a bond, due to the possibility of a change in the asset's value resulting from variability of interest rates. There are a number of standard calculations for measuring the impact of changing interest rates on a portfolio consisting of various assets and liabilities. The most common techniques include 1. Marking to market. Calculating the net market value of the assets and liabilities, sometimes called the market value of portfolio equity. 2. Stress testing this market value by shifting the yield curve in a specific way. 3. Calculating the value at risk of the portfolio. 4. Calculating the multi-period cash flow or financial accrual income and expenses for n periods forward in a deterministic set of future yield curves. 5. Doing step 4 with random yield curve movements and measuring the probability distribution of cash flows and financial accrual income over time. 6. Measuring the mismatch of the interest sensitivity gap of assets and liabilities by classifying each asset and liability by the timing of interest rate reset or maturity, whichever comes first. 7. Analyzing duration, convexity, DV01, and key rate duration. Then, how to mitigate interest rate risks? The most popular strategies to protect against rising interest rates include 1. Buy interest rate futures. Sophisticated investors can purchase futures contracts on government bonds or interest rate futures. These trades enable them to lock in a certain interest rate and hedge their positions. 2. Sell long-term bonds. Many individual investors hedge against rising interest rates by selling bonds, which tend to see their prices fall as yields rise, particularly in bonds with long maturities and low coupon rates. 3. Buy floating rate or high yield bonds. Many individual investors also hedge against rising rates by transitioning their portfolio from long-term to short-term bonds, like high-yield bonds or floating-rate bonds. The inverse of these strategies can also be used to protect against falling interest rate environments. And finally, there are some popular alternative methods to mitigating interest rate risk, although they are less direct than the 3 aforementioned strategies. Precious metals tend to rise in value as interest rates move higher, which means investors can purchase them as a hedge against higher rates. Equities also tend to outperform during rising interest rate periods, which means it may make sense to transition a portfolio's weight from bonds to equities. In particular, growth stocks tend to do the best when interest rates are on the rise, while dividend stocks become less attractive. The opposite is true when interest rates are on the decline. Thank you very much for watching.